Since we did our last update. So as you can see, this is the last time I recorded a video. Since then, I've already bought 5 more times. This is 15 weeks worth of buying into JME. Tomorrow is gonna mark the 16th week of me constantly purchasing of GameStop. So in terms of my portfolio right now, obviously we're down. Let's see, roughly about 53 bucks, since my cost average on this account is roughly, let's see, where is my cost average? $22 right now. So right now it's currently 18 bucks. So that's where we are with in terms of portfolio. The next thing I'm going to explain will be a lot of people are talking about DRS constantly, and so here's a big blurb. You can obviously pause the video and read this, but I'm not gonna read this word for word. So basically, people who are in DRS, it essentially means that what you're doing is that you're asking a transfer agent to speak on your behalf to ask the DTC to send that share of that particular company under your name as a ledger. So back in like 1920s, 1910s, right, for example, right, ledgers were always been a thing. Like, for example, if you want just not only just want like to have people know that you are the owner of this company, there's usually physical certificates. So with DRS, essentially is the same thing but electronically. So is DRS good or bad? It's just another tool to ensure you as the holder know that your shares are not being lent out, and also you own that share. It's no longer in the hands of like the bank, the institutions. It's now in your hands, because the DRS agent, in this case, let's use Computershare for example, like their company structure as says, what they do is that they go to their broker at the DTC and say, hey, I have somebody that wants this particular company's underlying shares. Can you please transfer that? And then obviously the transaction happens, right? So once that is done, the DTC will award the transfer agent the share, and the share will be notified to you as the DRS holder of your share. So now you know that it is in your hands and it is not in nobody else's hands. You basically became your own broker, because again, the transfer agent only holds on your behalf. So they're not like a bank or institution like that or anything like that. They can't make money off of your share, because there would be legal litigation problems that will come with it, because a transfer agent cannot do that. A transfer agent should do as their title is, which is transfer, right? So the moment they start lending it out and making profit off you, then they become an institution. So obviously there's litigation issues if they go through that. So again, if you're a DRS holder, you're completely fine. There's nothing wrong with it. There's intrinsically nothing wrong with DRS. With that being said, there's a lot of bad actors that make DRS like the be all end all, right? So the whole point of people pushing DRS is trying to register all shares in a way that the market makers cannot use these shares any longer and force a squeeze. Like, again, it's just another tool to let people know that, hey, I own this share. And the thing is, by the time that happens, by the time you already reach full DRS, there's a possibility that by the time that price action happens, we're gonna have like another split, right? Which means there's a bigger pool, and it's just an infinity game. So I'm not gonna waste too much time talking about this, but in overall, DRS, there's nothing wrong with it. It's good. As to explain back to the other people who are long-term holders, short-term holders, traders, institution hedges, it's just that the moment it gets removed off the pool, that means you have a smaller limited pool, which means that when this small volume moves and the large price action happens, that's the reason why it's happening, because the pool has been removed and now it's a smaller pool, right? But with that being said, right, I did read the computer share. I don't know if I have it open. No, I don't have it open. I had it open before. The DRS something website that talks about there's about 22 million shares roughly that is currently DRS. So again, intrinsically, is it bad? No. Is it good? No. It's just a tool. Okay, I'm being objective here. It's just a tool to let you know that these shares are yours and they're not being lent out. And if you were to do a transaction, a sale or a buy, actually let me rephrase that. If you do a sale, you know that it is yours, and they will you will sell it to the back to the DTC to whoever wants to buy that share, right? So it's just more work essentially, but it's just for people who just want to feel comfortable knowing that their shares is theirs, not the institution, because the institution holds on your behalf, but they are the main beneficiary according to the terms of service, right? So if you're doing like a registered account, like your Roth IRA or your TFSA, what should happen is the institution must hold that share on your behalf, because a registered account has a lot of traceability in it. But if something happens and they are lending out those shares in your registered account, and you do a sale, but they can't do a sale because your shares are not there, then there's litigation problems there as well. You can actually sue the company for that, because under governance of the government, how they set these registered accounts, they're in a lot of scrutiny at that point. So people who are in registered shares should be safe from lending their shares. Now, if you have a margin account, do understand that you are open room to have your shares to be lent out as well. So that's the whole spiel of share ownership, right? So it depends on your account type. So if you're a registered account, registered means like tax-free saving accounts, your retirement accounts, your Roth IRAs, your TFSAs, blah blah blah, whatever registered account, whatever country you're in, they should be held within on your name on your behalf as the main beneficiary, because again, there's a lot of traceability with those kind of shares. Whereas a cash account, a margin account, the government has no governance over that. So basically means it's the Wild West. So depending on how your terms of service is written, I understood as soon as I signed up with IBKR, Interactive Broker, and Questrade, and Wealthsimple, I have 3 accounts of GME, by the way. I understood that these shares could be lent out because it says in their terms of service, somewhere in there. Read it. But I know most of you don't read it, so I'm just explaining it for you to know. So moving on from DRS, let's start with a quote, because moving forward, we're going to see quite a lot of dumb things that are going to be talked about here. So, investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Vegas. So, by Paul Samuelson. So again, it is an economist. Really good principle here. So again, there's a lot of people who are pushing the whole point of the stock price and everything and revenue and everything like that. To me, as a long-term holder, right? So long-term, let's do some house rules here. So if you are a long-term, you're looking at 5+ years. If you're a short-term person, you're looking at between 1 to 5. And if you're a trader, you're looking within 12 months, right? And the reason why I choose these parameters, because it makes my life easier to figure out who's who, right? You're a short-term investor, you're a long-term investor, and you're a trader. Very simple, an option trader. A very simple principle. So that way it's black and white, because there's a lot of people who like to interchange these words just to make their, story a little bit more convincing for whatever type of person you are. So again, I am a long-term investor as well a short-term trader as well. And you're probably thinking, what the hell are you talking about? Why you're a short-term trader or why you're an option trader? Again, I'm here for making profit. I'm not here to buy a company that's not going to make profits for me in the long term, right? Because again, as a retail investor, you should be emotionally detached and understand that you're here to make a profit. Don't give me that weird story of I'm here to, fight the right. Forget morals, okay? Nobody cares about morals, okay? AMC investors, especially you guys, talking about like fighting corruption. This is why it's dumb. So, moving forward, let's talk about some. Okay. Another thing I want to talk about is also options. Options, are they bad? Are they good? It's just another tool. Just like DRS, it's just another tool to trade. It's just done differently. So intrinsically, it does nothing. Besides, if you're doing a cover call, which is what I've been doing recently, where I am the casino, right? And I'm willing to bet my asset, which is the casino itself, to degenerate gamblers that want to buy my shares through options. So again, does it help? Does it not help? It's just a tool, guys. Let's be real here. All these things, DRS, options, all these terminologies, they're just words. By end of the day, the stock market is very simple. You have a buyer, you have a seller, you have a pool of how much you can share that pie, okay? So picture yourself eating a pie, okay? there you have a big pie, and you cut that pie a little bit, your value per pie from that point on is more expensive. Why? Because there is high demand and low quantity available to purchase. That is how price action works. Because remember back to, I want to go back to the image before. Here, primary IPO. So this is the initial company's original share that they decided to let people be first buyers. That would be your, you know, your hedge funds and stuff like that. Big money guys that are allowed to see the IPO before it goes to public. And then once it goes to public, we go under called the secondary market, which is us. We are buying it after the fact. So whatever remaining shares available is you guys. So the whole point of how the market works is we are the secondary market. So the price action and the shares remaining does not reflect the company's performance. Company's performance is reflected by how they do operations. So that segues into Q2 earnings coming up. So I've been working on a balance sheet Q2. I never thought the day this is going to happen, because here I am having to talk about revenue, top line revenue all the time with a bunch of, I'm starting to be like brain dead constantly talking about these things. So in terms of operations, right? This is where they are in terms of net sales. Oh wait, this is quarter two. No, wait, there's no cuts, by the way. So originally they were making about 1.6 billion, then 1.2, then under a billion, and then back to a billion. So again, you can see that there's a decline. I don't know. Oh, sorry. This is decline in SGA. So these numbers are actually good. So this is SGA. Sales, general administration expenses are going down year over year. So you can see that it came from 2018 to 20. I'm also collecting 2017 data. It's just you can't see it, but I'm just choosing the last 5 years. So between 2017 and 2018, SG&A dropped by 50%. Between 2018 and 2019, it dropped down 15%. Then it dropped another further 24%. And then once all that's done, now their SGA has basically became flat between quarter to quarter. And this is year to year between two quarters. Okay. In terms of, let's see, where is it? So in terms of gross profit, you can see it's kind of relatively, obviously it came from a higher number, but the thing is, you also have to make a correlation between their SG&A costs and also their actual gross profit. So in this case, their gross profit is actually lower than their SG&A currently. But remember, there's a lot of expenses going on right now with GameStop, because they're constantly churning over their current store count. So there's gonna be a lot of work with legal fees and everything, and transfers and stuff like that. And there's a lot of administrative stuff happening. But because again, the company, like it said multiple times during their quarter one report, they're constantly talking about their priority is still reducing cost overhead as of right now. Let me see. How can I do this? Give me a minute here. I'm trying to figure it out. Let's see. Window. Is it this one? Yes, this one. This is their quarter one report. No way, there's no cuts. Anyways, as you can see that they have highlighted multiple times in their business priorities is constantly company infrastructure. There's a clear indicator of sustainability issues right now. So right now, in the foreseeable future, okay, they will cut more stores, because again, the more stores you cut, the more you can have more lean business and focus on other things once you have all that done. Because to be honest, there's a lot of legal things that are happening, legal changes of how they're going to operate things, because once they start doing digital, and the reason why this is important is because nobody reads the policies of how EU does things. So the EU has a very, very strict policy with data protection and everything like that. So the more GameStop removes itself from the EU, unfortunately, they're going to focus on finding a way for the digital product. Once they are working on it, of course, they're pushing the sales for that. Once they have established what their digital product is, then they can start rolling it out, because right now the priority is rolling out in America. So the only place that really matters, in my opinion, is just focusing everything in America. If once you finish your technical technology like improvement of e-commerce, because that's my priority. If I was a business operator, I would rather focus on e-commerce, because I'm going to bring you guys to another sheet where we're going to talk about um, revenues here. So as you can see, this is a quarter two report of multiple companies involved plus the company's GDP, which I mean not companies do the United States America's GDP. So the reason why I look at the GDP, it gives me an idea of how wealthy the nation is going on right now, because I'm a Canadian. I have to look at these things. So right now, in my estimates, that with inline growth, and inline growth is talking about like being the same as not Bed Bath, Best Buy, in line with Best Buy right now, because Best Buy in this calculator right here, you can see over the years with their quarter twos, right? Their revenues have basically skyrocketed back during pandemic, and then they crashed, and then it continues to crash. So we can see that the trend in a 5-year term is flat. So basically, they're making the same sales back in 2018, 2019. So again, we're looking at possibly the same sales with GameStop at 2018, 2019, flat. So because again, they both are sharing the same space of specialized retail. Okay, so it also with noting that the country's GDP has become flat as well, which means that people's money are about roughly the same, and people's spending is roughly the same. So between 2018 and also 2023 is about the same. So if I were to talk about this like a year ago, that means there's people more spending. My estimates might be different by then. But then right now, we're currently flat. So in my opinion, we're probably going to either be, we're most likely going to be flat in terms of earnings. If not, worst case scenario, which is I'm using something called compound annual growth revenue, and this is calculated by what's known as CAGR. This is calculated by like the last 5 top line numbers. I mean, from the top number and then the bottom number, and then you get your percentage between the two. So there's the math for it. So again, so worst case scenario that we make just a bit above $1 billion. And then best case scenario, that means that we're now back, in my opinion. The reason I chose 4% is I'm using estimates of trajectory between now to 2030 of the retail space in general, brick and mortar. So there's an estimate from all sectors combined into in the specialized retail industry showing growth 4% moving forward. So that includes your Bed Bath Body Works and stuff like that, and also Best Buy and all those specialized retail stores. Okay. So with that being said, I also have Amazon on my tracker, and this is their Q2 report. And remember, you have to put a little bit caveat with Amazon, because they do have other services as well. With that being said, they have showing a trend of about almost 18% of revenue top line growth per quarter for every single second quarter that they have performed last 5 years. So if GameStop is able to convert themselves from just being a simple brick and mortar retailer and pursue online sales just like Amazon, then we're going to have much better margins at that point, right? So again, and in this last column right here, this is Nintendo, by the way. I chose specifically Nintendo compared to Microsoft and Sony's because Nintendo has been showing strong sales with GameStop. Simply because whenever people purchasing things, 9 out of 10 times, or 10 out of 10 times, basically, every time I shop, there's always people buying something from Nintendo because their products are more highly sought for in the stores than other products I've seen as well. So when you're shopping at a GameStop, most of the time I'm seeing people either buying Nintendo stuff or hobby stuff. In terms of Microsoft and PlayStation, people still buy those things, but the thing is, the publisher themselves has been constantly pushing digital sales versus physical sales, right? Whereas Nintendo, they have been pretty consistent of just constantly making sure that they will still give you the disc, still all that stuff. You don't have to buy things digitally. They are, in my opinion, the ultimate consumer experience publisher. simply because they give you the option of either buying the game physical or digital, which is really good. It's very pro consumer, and I'm a very big fan of it. So again, my estimates is, in my opinion, flat, but I also have a low range and a high range. So between $1 billion and $1.2 billion. That is basically my estimates for revenue. That's it for earnings. So with that being said, there's gonna be a lot of clowns that are always constantly talk about this. So again, back to my original quote was talking about gambling, right? This person's theory from Reddit is talking about short squeezes. And again, short squeeze again is another mechanic that the market makers and institutions and stuff like that, they understand how these things work. As a retail person, let's be real, let's be honest, you don't see this information as much as they do. And I know this because I've seen the Bloomberg terminal. I've been on it before. I've been to University of Waterloo, and you know, I have the opportunity of a friend of mine to show me the Bloomberg terminal and see what I want to look at, and it gives me all the news and stuff like that. Short squeezes, if you're making a fundamental, sorry, let me rephrase this. If you're making a play under the pretext of short squeeze potential, you're in basically Vegas at that point. So I don't do this. What I do is, let me see if I can pull it out. I don't know if I have it on here. As you can see, over the years, this is my actual dollar cost average of my 2 accounts. I'm not including my Wealthsimple account on here. This is just me calculating over the years. So my current dollar cost average is $42.90. Yes, I'm in the red clearly. But at the same time, this is where I was originally. So I started at 332. Then 2022, I started at 61. And then at 2023, this year, I'm at $42. So again, you see my total shares right there as well. So again, my profit goal for this particular year is, if it hits 53.92, that means I'm in the profit. And the reason why that 42.90 is not my profit margin number is because what I want to see is 8% growth annually. So that means at the start of my purchase until now, it has compounded to now $53 is my estimate goal as profit. So again, I'm here for the long term. I know what is my price action of growth, right? And these orange numbers are related to options. I've been selling options, and it does affect my price action overall, right? So you can see this is what I'm making in terms of option sales, right? So again, options are not bad, and if you're gonna be gambling, right, at least know what you're talking about, because this guy is trying to be a prophet about short squeezes. I highly recommend don't do that. I would recommend disconnecting yourself first of all, investing in yourself first before you invest into the market, right? And this is not financial advice, but like, this is what my personal journey I have done before. So in terms of my journey so far, I originally was doing paper trades. So basically, I go to this online little game from Investopedia where I just played like a room of, like, you know, buying and selling shares virtually without a single dime at my expense. And I was just learning it for about 2 to 3 years. Then I started buying back in 2018. Then I started buying actual shares into a company. At that time, wheat stocks was growing momentum, and I was learning momentum trading at that time. So at that time, I put in about 10,000. I came home about 20,000. So that means I doubled my money within a year, because I knew at some point, as soon as regulation gets closer and closer to legalization in Canada, I got out. It was easy. It was a very simple momentum. Like, I knew this was going to happen. People are going to pull the rug the moment it gets legalized, because they're going to show profits and they're going to show negative profits and all that stuff. I have a really good idea, because at that time I was studying more of behavior. It wasn't me being really good at technical. It wasn't really good at me being smart. It's just me understanding how people behave. And people were just like, okay, it's legalized and there's no money being made here, pull out. That's what I did. And as soon as that happened, I went to ETF, of course, because I didn't know what to do at that time. So I bought into ETF, which is VGRO, Vanguard's growing portfolio, at that time. And this was a short-term play, because I know that S&P 500 has growing up at that time. So that was in 2019. and I sold just before that in March. I had a rough estimate at that time that at the end of March there's gonna be a huge crash, and that's what happened. A huge crash happened, and I started buying a whole bunch of companies at that time because I sold at the high, buy at the low. And how did I guess it? It's because I kind of judged it based on how much negative news out on the internet at that time, and that was COVID at that time. And then as soon as earnings came in and people are showing negative numbers, people started running, and I kind of had a rough idea. And the reason why I had a rough idea that that was going to happen is because, again, I physically go out, I go see how people are shopping. I don't see people, right? Don't see people, don't see revenue. It's very simple, very logical. So, and then fast forward into 2020, that's when I started buying, obviously, my GameStop position in 2021, roughly. Okay. At that time, I was very skeptical about GameStop simply because, again, I didn't understand the company. I didn't understand what's going on. I didn't understand the thesis at that time. So again, obviously, I will not lie to you. I did get hyped up into the whole squeeze thing. But as time passed, I learned my lesson that, okay, the squeeze is gone. Or is it? Or does it matter? And the first thing that I learned in that time, I shouldn't be investing in squeezes in the first place. I should be investing into companies that are reliable. And in that year, at the same time as GameStop, I bought Apple. And obviously, I'm not going to show you my Apple position because it has a lot of my personal information I can't share. Because Quest Trade doesn't have like a simple way for me to share it to you. So unless I wrote down all my transactions like this, like I wrote all my transactions here, Apple has been my biggest winner right now. Obviously, same thing with Microsoft. I also bought into Texas Roadhouse, and okay, that was interesting. But anyways, earnings is coming up, and like every earnings, I'm ready to battle.